All right, thanks for joining us. Hey, everyone. We got Josh and I here today, and we're going through kind of what we call the commercial segment. It's a pretty broad statement in itself, but the main thing we've been looking at lately is occupancy, and where is that headed, and how is usage of this space happening. So I think it's helpful to just clarify when we mean commercial, what are we talking about? Because that's kind of a loaded question of a huge component of real estate.
Yeah, you also have two components of occupancy. You have occupancy like the space has a lease on it. You also have occupancy of are people actually walking in the door. So we've seen combinations of both of those over the last couple of years. So we can clarify both of those as we go.
Yeah, we are more focused on if people are walking in the door.
Exactly.
That one is more of our driving factor. We want to make sure that people are using the space. So, but we think commercial, the stuff that when you hear news or anything going on with commercial, I mean, it's a pretty broad spectrum, and most of it is talking about office. Most of the news or information talks about office. Our commercial stuff, we really have three types. We have medical, we have our purely like government type space, and then we do have standard office space where people are just going to work. So those are the three that we are in, and even within those, our medical spaces are very like patient centric. So these are places where patients are coming to see a physician. We also have some pharmacies and some lab
Surgery centers
where people are actually there doing medical work. So when we talk about medical, that's what we mean. We do not have hospitals, other kind of stuff. And then on the office side, all of our office is low-rise suburban. That is the core of what we have. And there's some components that we believe make that it's its own segment in our opinion, right? In our market. They don't have really low-rise suburban in New York. It's not something, but for us, we do here down in the Southeast. So that's something that we have always focused on when we say, if we're looking to office space, we want low-rise suburban.
Yeah, it seems like most of the media is primarily talking about kind of the tech use of office space, right? The Googles, the Apples, the big expanding companies out there right now. And they're mostly in urban centers, or they're building new urban centers around them. We're not leasing really to any tech companies, and we're not part of that market at all with the product we buy.
It's kind of a different planet.
Right.
Like when there's a big deal here in Atlanta where Microsoft bought like 100 acres on this brand new park made. They're going to make a mega complex. And that's great and all, but that's not in any relation to kind of what we're doing. That's a positive sign for Atlanta and for investment in that area on the west side of town. We have some deals over there. So that's all positive on that sense, but that's not commercial real estate that we're dealing with. That's different. It's a different ballgame.
For most of our commercial spaces, really where people live. So if you think about the environments that you guys live in, and when you're driving down the road, you're seeing your retail, you're seeing your Target Center, your Dick's Sporting Goods, and all that. And there's always like some small kind of 2-story office building next to it that has, surface parking. A lot of them look kind of maybe colonial style that has a door entrance on the outside.
Mostly like brick, 2-story.
Yeah, almost looks like a house that got expanded. That's a lot of what we're targeting is
really big house.
Right, really big house. We're basically office where people want to live, that they want to reduce their commute, they want convenience, they want to be around their kids' schools and all that.
Yeah. So we think about how are those performing and how that's working in the space right now. We have a little bit of just kind of the overview of the market as a whole, and then what our specific deals are doing. We've talked for a while about a software we use called Placer AI, and that is how heavily on the retail side, but also on the commercial side, we're tracking to see, are people in our offices? Are people in the commercial spaces that we own? That helps us when we're looking at a renewal. That helps us if we have actually been looking at expansion with a lot of our commercial tenants. So that helps us to determine how is this location performing. But in the market, with some of the stuff that we're not necessarily in, kind of the bellwether of, we're looking at the kind of the work from home or back to office part, is we are always tracking basically the largest buildings that are in a market. So here in Atlanta, 2 core ones, we have the Peachtree Tower that's downtown, 191 Peachtree, the King and Queen building that's the north side of town. And then in Charlotte, there's a Bank of America building. And these are 1 to 1.5 million square foot buildings. These buildings are bigger than our entire portfolio in one building. But we're looking at those to see what is the trend of, are people going back to them? And for the full year of 2021, it was really slow. It was maybe their foot traffic was at about 20%. And now we're seeing that 191 Peachtree and Bank of America in Charlotte are up around 80% of pre-COVID occupancy on foot traffic. And we're getting that information from Placer, which is aggregating cell phone data. So it's really showing our cell phones, as long as you have a cell phone, which is, I think, the majority, right? So as long as you have that, that is going in to those locations, we're able to see where people are moving to. And you know, that's kind of a personal opinion on what you think from the work from home or not work from home, but there's a lot of people that are going back.
Yes, and you know, with all the different cities that you guys live in, whether it's Dallas or LA or San Francisco or New York, you know, we have national access to this data. So we frequently will go on and like look at the whatever the most prominent tower is in those different markets and see, you know, are people going back to the office? And we're seeing that, you know, to Dave's point, it's 80%, you know, most people are back now.
And the jobs in those locations are normally very well paying, but they're also, you know, highly able to work. They're mostly services based organizations that are heavily using technology.
Like
They're not
law groups.
manufacturing jobs that are going to these towers. So,
Right.
so they should have flexibility of work, and they are going back in those locations.
You used to go to one of those locations for a long
I
time.
used to be in 191 Peachtree.
Yeah, as
I
a
know that one
consultant.
very well.
Yep.
But so other news that we're hearing too is just that working now, it's never going to go back to what it was pre-COVID. That's kind of like the general assumption, is work now is never going to go back to what it was like. That may be true. It's probably going to be different in some sense of it. Even in our office, we have more square footage, we have less dense of an office than pre-COVID. So there's some shift in what that's going to look like. But the other part is impact to deals. So we're thinking about, and we've been going out, we've been trying to buy a mix of these deals, everything from medical to commercial office to the government spaces. We've been trying to buy those over the year. The first half of the year was pretty darn successful. We were able to buy quite a few deals in that time frame, and they all have some kind of attribute that makes them specific to one of those categories that we like. But even now, we've seen rates obviously rising. That's kind of one dimension of it, but we're not really seeing much change in pricing.
Yeah, so cap rates have been fairly stagnant through this rising rate environment. We, especially in commercial office space, it hasn't responded as quickly as rates have responded. Right? We've seen rates run, you know, and we're mostly getting community bank debt, so it's not necessarily directly tied to a metric. But we saw rates, you know, in the low 4s to mid 4s, and really run up to kind of 5.25, 5.5. So pushing about 100 basis points. But cap rates have still kind of held strong in that 7.5 to 8.5 cap rate range for commercial office. And I think a lot of the market is waiting to kind of ride the storm and let interest rates settle down before they start adjusting price.
Yeah, in the commercial space, you know, most of our leases are 5-year leases. So if you're in the middle of a 5-year lease in your cash flow, and you don't really need to sell, you don't need to shift direction. So for us to find opportunities, or where a seller is willing to adjust their price, they have to have a reason to want to go. And we're just not really seeing that right now.
Yeah, and to Dave's point on the leases being 5 years, most debt terms are tied to those lease terms. So if you don't have a lease coming up, that probably means you don't have debt coming up. Probably means that you don't have a trigger to force you to move. So just ride it out.
And you're getting cash flow.
And you're getting cash flow.
Right. So on that sense, our volume of deals that we're seeing out there is a lot lower now than it was even just 3-4 months ago.
Oh, absolutely.
So that's kind of tightened up. And then some of the stuff we are seeing is like $30 and $50 million portfolios of kind of stuff all over the place. And that's not necessarily our sweet spot of operating as well. But those bigger, complex, or, you know, multi-state portfolios are out there. Those are pretty tricky to underwrite and figure out in this current market, though.
Absolutely.
So if we talk about how our deals are performing and where we see our deals going, let's talk about medical first. That's kind of our segment of the commercial space, being that medical. And we have about 215,000 square feet of patient-centric medical facilities, and we're 97% occupied.
And inside that 97%, it's an amazing accomplishment, but we haven't actually leased that much of it. We've been signing renewals and expansions.
Yeah.
On, with every time a lease comes up, people are wanting to stay, people are wanting more space. And so our medical space is really actually becoming a bigger part of our portfolio. As we have a non-medical user vacate, we will have a medical user expand.
Yeah, and that's in some of our locations where we have a mix of, in some locations, we have a mix of all three of these tenant types. So we kind of divide that asset into three types of categories. But a lot of times, yeah, we're seeing that medical tenant want more space. We're also seeing where on one of our deals where we have two medical tenants that are now like, hey, I want their space too. And then they want their space. So we're kind of got a little bit of a competing situation of how do we balance, like, what is the best long-term medical tenant in one of our locations. We've done a couple leases though, new leases that are build outs, and we're typically looking at about $50 a square foot when we're doing a medical build out. So that's significant. That's a significant investment, not only on the landlord side, but the tenant's also bringing a big,
square foot.
yeah, they're also bringing that much of an investment to the deal as well. And we signed about three of those leases this quarter, in the second quarter,
right,
recently.
Yeah, and so it's a major encumbrance for a medical tenant to move. Obviously on the landlord, that's where we feel it, but it's also on them. It's costing, give or take, $100 a square foot, 50 on, say, the build out, and then another 50 on really I would call it the soft build out, which is the furniture and the equipment and all the little details that everyone kind of takes for granted, but until you actually do a move, the pictures on the wall matter a lot.
Yeah, it's like furnishing a room in your house. You're like, why did that cost so much? And then you got to do that to 15 patient rooms. That certainly adds up.
So this segment of our business we continue to like because of how sticky those tenants are, how hard it is for them to move. The other part of that is, if you think about medical users like a doctor or a surgeon, they have a defined market area. So they can't just pick up and move all the way on the other side of town. They have their market that, if you're a general practitioner or doctor, like most of your patients are within 3 to 5 miles of
right.
where
Yeah, it's very localized.
So you only have so many office spaces that you can move into, and you're in one, you've been there for a little bit of time. You'd rather stay there, maybe ask for a little improvements, new carpet, new paint kind of stuff, versus picking up and relocating your customer base.
Yeah. And we saw that with our Parsons medical deal. That's it's just a little bit north of where we're at right now. We're in Norcross, and that's up in Johns Creek, about 15 minutes up the road, maybe. But that is a medical complex. We own one building in a medical complex of about 7 buildings, and everyone in there's any kind of medical need you could have to be fulfilled within that facility there. It's got everything from
plastic surgery to cancer
children's
removal,
dentistry, everything. It's got it all. So the other part of it is they're always trying to be near each other, and that's right across the street from me. So it's pretty close. So, that location is pretty much where it's at, and we're in there. So, and that's an asset we purchased with some vacancy. We had to move out when we were closing during COVID, and we were able to backfill two spaces with medical tenants there. That's been good. The other part of it that we lump into commercial is the government side. So when we look at our government assets that we have a mix of those, and we have a VA clinic that's kind of also but like government backed, but also medical oriented. And then our normal government tenants, these are very specialized space. So we're liking those investment opportunities because the market is limited. The first one we bought was the TBTC one,
right? And
their requirement was that they needed 50,000 square feet on one floor,
on the second floor, with 4-to-1 parking in downtown Chattanooga. Like that.
I don't know if there are many other buildings that.
Yeah, we were the only building that met their qualifications, so it worked out pretty well.
Right. Yeah. So that's a great position for us to be in with that tenant, that government entity. And for them to go find another one of those, it's going to be very challenging. It dramatically limits the pool of available space.
We're looking at some. We're basically on the distribution for VA clinics and other government entities that are looking for space. So they basically send out the specs, and it is. You can build to their spec, of course, but finding existing that matches their spec is very, very challenging.
Yeah, it's hard. So with that, we've got about 450,000 square feet of dedicated government use space right now. And some of that is DoD contractors as well that are, that's not a government agency, but we have, we have an asset where we have the DoD basically procurement office, and then surrounded by that is other DoD contractors that are filling that space. And that one was even, we toured that asset, and some of the space, they're basically like, no. They had a helicopter simulator. They're like, you're not going in there.
Yeah.
You're like, we can tell you what's there, but you don't get to go in and see it. So that's, again, moving that or changing that is pretty challenging. And our government space is about 90% occupied overall. And the majority of vacancy we have is space in a building that was purchased that it already was vacant, that is there. And then to lease that space, it's really an effort to work with the existing tenants to see if they need that or want to utilize that.
Yeah, because a lot of the government space, they have to approve any other tenants that come in the building. And so you kind of have to work with them on really.
We're not kind of.
You have to work with them.
Yeah.
On whether they want the space first and they have first right of refusal on all the space. So do they want the space first? And if they don't, who you're willing to be friends with and share a parking lot with.
Right. Yeah. So that's that part of that business. But overall, I mean, at 90% occupancy, and that's also kind of what we didn't pro forma those deals to be 100% occupied on government. We knew going in, they had that vacancy. So we had planned for that, and we can meet our metrics with that in place. The other part, the last part, is really the suburban office. And that's where, we got into some of the suburban office stuff, and we've seen a lot of leasing demand for existing suburban office. And these are places that are, like Josh was saying, like much closer to where people live.
Yeah, where schools are, really where you want, where your whole, everyone talks about they live in their own little bubble. Well, this type of office allows you to live in your own little bubble and really never leave it. Yeah, I live 3 miles from this office, so.
And that's our typical rents in those spaces are in the $15 range, right? Like the office we're in now, many of y'all have been to our corporate office here in Norcross, and the space, we're targeting $15, $16 in rent. And that's what we're able to get with existing built out office, where you have mostly 2,500 to 3,000 square foot spaces. That's kind of our standard in the suburban office size. Occasionally we'll have someone that's like 8,000, 9,000 square feet, but that's pretty rare.
Right. It's really, 1 or 2 principals of the business and maybe 4 to 6 support staff. And that's their business. It operates well. It's been around for a little bit, and they're looking for a 3-year lease.
Yeah, that's the majority. So on that though, we're about 70% occupied on our suburban office as a whole, with our biggest vacancies being essentially white box space. And that's really focused in 2 assets. In our QOZ fund, our North Graham and our Lupton buildings that are wide open space that's vacant. And we think about like, what is our opportunity within these assets? Overall, we look at our placer data and we're seeing people coming back to offices. We're seeing demand go up. We're not seeing demand increase for clean slate office. We have for medical, we're seeing clean slate medical. We've done 3 of them this year already that we're doing build outs on. So we're seeing that demand there. We're not necessarily seeing that in the office space. I think most of the people that are going back and are doing offices are just going into something that's.
Yeah, and most people are moving relatively fast. White box build out, 3 to 6 months?
Yes.
So
minimum. I mean, we even permits and entitlement to get that stuff done is going to be 3 months.
Right, versus existing space, we can throw down new carpet, put up, new light fixtures and paint the walls in 2 to 4 weeks. So most of our suburban users are wanting to move relatively quick. They want to see, they're not really looking to apply creativity to their new office space. They want to like, oh, okay, yeah, this works. They don't want to have to think about, hey, where the walls.
There's not a whole ton of creativity in 2,500 square feet.
Right. Exactly.
Right. You kind of got your basics.
Right.
And that's what it is. So when we think about the deals we do have that are vacant, we've got to be creative in how we're utilizing that space. And the OZ fund that we have, those deals, we're looking, one of the deals, we actually had a tenant that came and said, hey, we want 23,000 square feet. And then in that conversation, like, we might as well just buy the whole building. So that building, we're not going to do a build out. We're in contract now to sell that to that essentially tenant that's going to use it. It would have been great if we could have leased that whole thing to them and gone through the build out and had that as a long-term tenant. But their interest is more, they're just going to buy, they're going to buy it and they're going to occupy it. So one of them we're exiting. That's that 1500 North Graham deal. Our plan there is exiting that to a new tenant that's going to basically take the whole space. They're going to use it for themselves. And we're looking at the same situation in Lupton. That's much earlier stages. North Graham, we're under contract negotiations now. Lupton, we're soft talking with a group on doing the same thing as well. Those will be positive. I mean, there'll be positive gains. That's obviously not what we were looking for, more long-term cash flow out of those. But if we can turn them and not have to go through the CO and the full build out of a tenant space, I think that suits us pretty well in that opportunity. So otherwise opportunities, I mean, with occupancy and people really, we are seeing it rise. So in the spaces that we operate, we are seeing demand and we are seeing occupancy. So we're still very much looking for deals that fit our unique footprints. And we have a very narrow acquisition box compared to commercial as a whole, right? But we have a medical deal we're working on now that's backed by a local hospital. It's one of their outpatient clinics. So there's people going in there. We're getting debt quotes in the 4s, maybe high 4s that we'll be able to get through at, but it's going to be a solid cash flowing deal with good debt with a long-term lease. So we're still finding those opportunities, not as many as we found in the first half of the year. We found more in the first half of the year, but we're definitely still seeing that stuff out there. And then we're also trying to find more creative ways that we can get into these spaces. So medical wise, and again, overall, we're typically buying smaller scale deals if they're in the 5, maybe 3, but normally like $5 million to $15 million range. We've only bought 3 deals over $20 million.
Right, exactly.
Across
everything
we've done. We've only bought 3 over $20 million. So we'll normally call it that $5 to $15 million range. And we're working on some opportunities now where we can partner, or not even just do purely the real estate side, but partner on the operator side of medical practices that we can then get involved in the real estate with that angle as well. So
what we're seeing out there is that there's a majority of medical practices, like well over 70%, are just individual doctor on their own with their individual workforce and team. And they use standard practices and procedures, but they really don't have kind of the economies of scale of multiple doctors, multiple people in the practices and the software needs, et cetera, et cetera. They're not getting any scale with that. And by working with them and providing basically an aggregation model, bringing more doctors together and working with them on the real estate space, we can provide them a much better cash flow, much better quality of life, and future earnings.
Yeah, if we invest in that, and we did something similar when we looked at on the retail side, and we've tried to work with retail operators, and we've done this with two different groups where we're working to be their go-to partner, and we've done everything from real estate deals with them, loan money into the operation. We're not necessarily investing in those retail operations, but we've done everything on the financial side to partner with them and help them get into more real estate spaces that we can purchase. So looking to do the same thing in the medical side as well. And quite frankly, we'd probably look at doing that with anything that we're like in on the real estate with. It's like, if we can find an operator relationship that helps facilitate that, it benefits us.
Absolutely. Yeah. So over the next week or two, we'll be sending out a package to really explain our operating partner model and in the medical space. And we can talk more about that as that comes up.
Yeah, we're excited about that though. And
absolutely.
And finding those avenues. Again, it's a very creative look at how we're kind of finding value in the commercial space while we stick to a very, very narrow approach. Sometimes we think our approach is pretty wide, or the reality is it's pretty darn narrow in most cases here. So.
Yeah, we basically apply the same, yes, we've done lots of different asset classes from multifamily to mobile homes. So the commercial space, we'll talk about flex a little bit later today. But at the end of the day, the business disciplines have been the same the whole time. It's just apply the same business discipline and execute.
Definitely. So overall, we are seeing rising occupancy. We're seeing our commercial deals performing well. We have, debt changes is really isn't an impact to us right now. We have all fixed debt. So our debt is fixed. And the majority of costs, we see stuff rising through inflation. Now, inflation is definitely a concern, but when we see inflationary costs rising, we're passing that stuff through to tenants on our CAM reimbursements, which are set for a year, and then we reset them for the next year. And we do catch-ups to true that up. But for the most part, those costs are then flowing through. Now, we don't want inflation to go crazy and have our landscaping costs quadruple. That's not helping the cause, because that makes it more expensive for our tenants, and we don't want that. We want our costs, our tenants, really, I mean, we want to earn a good return, but we want it to be as low as we can for them so that they're more likely to stay there.
Right. And one of the biggest value adds that we've executed on the commercial office space is taking a lease that did not have CAM. And, maybe it was signed 3, 5, 10 years ago. And as that lease becomes a renewal, we embed CAM into, discuss it with the tenant and make sure that they understand it. But the modern approach to, maybe CAM wasn't part of the leasing activity 10, 15 years ago, but it is now. And it's helping everyone basically absorb the shared cost of inflation. So
on the other side that benefits all of our new renewals that we're getting is we're seeing significantly higher. One, we're getting annual escalations on everything. And two, the rate of those annual escalations, leases that we've inherited have sometimes been like 1.5%, 2%. Now we're seeing 4%, which 4% over 2%, that's double.
that's double.
Right? So that's 100% increase. Yeah, 2, 3, 4. I got enough fingers to do that one. But yeah, so 4%, every year for 5 years, that's significantly different than what it was a year ago on a lot of leases. So we're seeing that. So we're having costs that go through with rising incremental increases annually, not every 5 years, annually. So our cash flow and our margins are really improving with fixed debt on these assets going forwards.
And it takes some pressure off of really off the deal that we don't have to really, if we can get a 4% escalation in there, we can be a little bit softer on maybe the rate today and not have to push that turnover to realize today's rate because we're getting such strong escalations.
And we get to keep a tenant there, for the most part, doing that. Cool. So that's the inflation component, the debt component being fixed. We feel like we're in good shape. And with occupancy, from what we're seeing, going in the right direction, we're pretty positive about where things are going on the commercial side. Now, finding opportunities that fit in our specific box has been more challenging. And we see that probably being a little more challenging for the next 2 quarters going forward. Finding, our ideal opportunity is a tenant that's in place with a little bit of vacancy that we can go lease out. And finding those kind of needles in a haystack has definitely been challenging. Nathan on our team is out there beating down every door he can find, though, to make sure that we can get them. And we have some coming in, but it is definitely a slowing down in finding those opportunities where a seller is willing to sell. That's the other part. We can find it. They got to willing to sell too. So. Okay, so that kind of does it for our commercial side. We're going to open it up to questions and see what anyone is thinking here, and hopefully we can answer them well with some real guidance.
Right.
All right, we have a question from an attendee. You all referenced CAM earlier. What is that? What does that stand for?
Oh, that's a good question. So that's common area maintenance. And how that works is we're submitting basically budgets to each of our tenants on an annual basis, and they are responsible for the common area maintenance. So imagine landscaping, common area lighting, cleaning the parking lot. If sometimes we handle cleaning within the facility, and all those costs are then typically on a monthly service contract that we say, hey, this is going to cost $1,000 a month for the year. And then that is added into their rent, and they pay us an additional $1,000 a month to cover that stuff. Now, when we get to the end of the year, if it costs $13,000 or it costs $11,000, we true that up against what they paid, and they'll either owe more at the end of the year or get a little reimbursement on that cost. So those common area maintenance items are shared with the tenant. And a lot of times those were not in the lease. We were talking about that, like they were not in the lease ahead of time. We've added that line into the lease.
All right. to office spaces. With office spaces for which we have no traction, what can be done to lure in more tenants?
We've tried a lot of creative things. I mean, the majority of the true vacant empty space we have, we're looking at exiting to a tenant that was basically taking that whole space. So those are really just exits, and those are going to be positive exits. So that is good there. We're happy with that. On the space, on long-term available space that is vacant, that's not a white box. We honestly don't have a whole lot of it. You know, we have about 8%, 7% of our portfolio that's commercial that is vacant in that segment. So the only thing we're really doing there is offering larger TI packages to say we'll do a nicer build out. And if you're looking at 2,500 square feet, most of the market is saying, hey, we'll paint it and clean it. But we're also saying, like, hey, we'll throw in a little bit more there to make it even nicer for you. That's what we're doing on those things. And that's really communicating that with a broker, our listing broker, and the other side is going to have their broker as well. So we're basically pushing through the creative. I don't know if that's necessarily super creative of saying, hey, we'll offer more in TI, but it's more of a financial commitment to it.
So what will happen to the vacant space that's sold?
So we the vacant space that we do exit, anytime we do have an exit, we're normally working on a 1031 option or allowing people to take their investment capital back. We offer both of those pretty much every time.
Yeah.
And how does inflation impact your costs if rent is fixed?
So that goes back to that CAM cost. Now, not every lease is the same, and not every lease has CAM. So we're still monitoring, what costs are going up, and we're seeing our biggest cost increases in things that are around. They're really the triple play of you've got transportation impacts, manpower impacts, and service impacts. So you look at something like pest control. You've got labor, you've got to travel to somewhere, and you've got to buy chemicals, and all three of those things have gone up in cost. So that's where we're seeing more price increases. And for the most part, the majority of the time that is in CAM. And if it is not in CAM, we are working on how do we negotiate that lease when it comes up. And then two, we are absorbing that cost, which obviously isn't the greatest thing we want to see happen. But if there's no way to pass it through, we absorb that cost. We're trying to make sure we negotiate those contracts with the service providers as best we can.
Another great question. If we sell a QOZ property and redeploy the capital in another QOZ property, will you still need to spend the required capital upgrades to meet the OZ tax guidelines?
Yes. So in a way, short answer is yes, but in a way, when we did our QOZ fund, the investment dollars came into the fund as a whole. And then that fund, the requirement of it at a fund level is to reinvest capital into all of our deals. So the deals we invest in have different amounts of capital that we're investing into them. Some have more, some have less on the improvements that were done. So in aggregate, as a fund, we will have to do that. Now we have already invested more in improvements than we did in initial dollars. So we still have some room to basically go buy a QOZ deal that we're not even really making any significant improvements to, because we've already made improvement dollars at a whole fund level.
Yeah, the example there is like the Lupton building we bought for give or take $48 a square foot, and then we improved it by putting another.
Oh, that equity was like $20 a square foot.
Fair, right? So so the equity, we only have $20 a square foot into basis, and then we put what 120 a square foot, give or take, of improvements in there. So we only had to put 20. So we have an extra $100 a square foot that we already put into the Lupton that we now apply to other buildings as needed. So if we buy a building and basically it needs nothing, as long as the equity basis is low enough, we're fine.
Yeah.
All right, one last question, process question. Quarterly reports are dated for the end of June, but when do distributions actually arrive?
Yeah, so we've been trying to make sure this has been as standard as possible for the past 3 quarters now. So we've been getting all of our reports and statements, everything goes out July 20th. So it doesn't matter what the day is. July 20th is when you're going to get your email that has all the reports on it. but we close the quarter. In this case, we close the end of June. So when we close the end of June, we do our disbursement analysis, and in Juniper, which is our investment management portal that all investors can log in and see their positions, we post that as the end of June. So that way it lines up with what the second quarter is. And you can see that every quarter we post it at the end of the quarter, but the distributions don't go out until the 20th of the following month. And depending on what day it is and depending on bank speed, it normally takes a day or two before those post to your account. So that's going to be, in Juniper, it shows up right at the end of June, but they're not going to hit your personal accounts or a trust account or investment account until the 21st or the 22nd of the month. And that should be pretty consistent. Now, IRAs are a little bit different. It takes slightly longer for us. All of our IRAs are held through equity trust that are self-directed. It takes a little bit longer for us because we're sending money to equity trust and it has to post to your account there. So we have a
Middleman.
a good middle process on that, but there's a middle process on that makes it take a little bit longer.
Those are all the questions. Thanks, everybody.
All right. Thank you very much, everybody.
Thank you.
Have a good one.